Could 50-year loans solve our affordability crisis? A reality check. If you've been trying to break into the property market lately, you know the reality. The deposit bar keeps moving, supply is tight, and the standard 30-year mortgage feels like a financial marathon. With the housing shortage driving prices up, a lot of buyers ask me if we should be looking at how the rest of the world handles home ownership, specifically countries that offer 50, 90, or even 100-year loan terms. Could simply stretching the loan out be the answer to getting more Aussies into homes? I've crunched the numbers on these global giants to see if we're getting the short end of the stick or if the Aussie way is still your best bet for building wealth. 1. The forever loan versus the Aussie sprint. In Australia, the 30-year term is sacred. The strategy is to pay the debt off aggressively so you retire rent-free. But in high-cost markets overseas, the approach is completely different. Japan, the multi-generational loan. Japan has historically offered 100-year terms and recently reintroduced 50-year loans. This is an intergenerational approach. You aren't just buying the home for you. You are effectively sharing the debt with your children to make the monthly payments manageable today. Switzerland, the indefinite mortgage. The Swiss model is essentially renting money. You might pay down 35% of the debt, but the rest sits there interest only forever. You get the house, but you never truly eliminate the bank's share. Sweden, the 100-year hangover. Until recently, Swedish loans averaged 140 years. While regulators have tightened this, the mindset remains. Keep payments low rather than eliminating debt. The reality check, adopting a 50-year term in Australia, would drastically lower monthly repayments, instantly making housing affordable for thousands more families. However, the trade-off is equity. In Switzerland, you are a tenant to the bank. In Australia, you are an owner in training. 2. The interest rate. Envy. Why can't we fix it for 30 years? The biggest frustration I hear at open homes is, why is my rate moving when my cousin in the US is locked in at 3%? It comes down to flexibility versus stability. The US golden handcuffs. US loans are often fixed for 30 years. If you bought in 2021, you have a 3% rate for life. But this has created a housing shortage of its own. No one wants to sell because they'd have to swap their 3% rate for a 6% market rate. The market is frozen. The Aussie roller coaster. We feel every move that the RBA makes. When rates hit 4.35% last year, we felt it. But now that the cash rate has cut back to 3.60%, January 2026, we are seeing relief immediately. The reality check. Your American cousin has certainty, but they are trapped. You have flexibility. If you aren't happy with your rate, you can refinance tomorrow. 3. The barrier to entry, the buffer. This is the real culprit behind the access crisis. It's not just the house price, it's the paperwork. Australia's safety net, the Australian Prudential Regulation Authority, requires banks to stress test you at 3% higher than your actual rate. If your rate is 6%, you have to prove you can afford 9%. This protects the economy, but it locks many first home buyers out. The US score game. In the US, it's about your credit score. In many states, loans are non-recourse, meaning if you walk away, the bank takes the house but can't sue you for your savings. It's riskier for banks, which is why their rates are often higher than ours over the long term. My verdict is the grass greener. While a 50-year loan sounds appealing for cash flow during a cost of living crisis, the Australian system offers a hidden superpower, forced savings. In Japan or Switzerland, you might pay less per month, but you or your kids are left holding the debt decades later. The Aussie 30-year grind is tough, but it forces you to build equity. By the time you retire, you don't just have a roof over your head, you have a tax-free multi-million-dollar asset. We definitely need to solve supply, but changing the long term might just kick the can down the road to the next generation.